Hi there, I'm Frank Wagner, and I'm the Vice President of Total Rewards for Cloudflare, where I've been for the last year. And prior to that, I was the head of compensation for Google for 17 years. And before that, I was a consultant in compensation covering the broad range of executive compensation, broad-based compensation, sales compensation topics for Hewitt Associates, now part of Aon Hewitt. And I've been in the field for 35 years plus, a long time in compensation. I've seen lots of change. And this is a time when there is continuing change and it's accelerating. Lots of interesting things happening related to the use of AI, the competition for talent, new data sources that are more proactive as opposed to reactive. And I just am looking forward to the next few years and see what comes.
Hi, everyone. I'm Ronnie. I'm the founder and CEO of Complete, a compensation platform for high-growth compensation teams. I'm joined here with Frank Wagner, the current VP of Total Rewards at Cloudflare, and prior head of compensation at Google for a total of 17 years. Frank, you've probably seen things in compensation that many of us wouldn't even dream of or expect to have come across our desk. Today, we're going to focus on a large part of compensation programs and what teams are focusing on today, stakeholder management. The number one topic that comes across our desk, especially as companies are innovating around compensation, is how to build a relationship with our board. Tell us a little bit more about what that relationship has looked like for you and what you think is successful for actually getting your piece across to the board.
Well, I think that you have to show a variety of things. One is technical competence, to show that you know the market, you understand their questions and their topics, and you also have to understand their perspective. So when I think about my interaction with our current compensation committee, as well as the Google compensation committee, there's a great focus on two primary things. One is run rate. You know, if we're in a tech company, we pay a lot of attention to that, and that is their primary focus. But the other is talent. And they think about it in terms of like executive talent, who's running the organization at the top tier, but also our best technical people and our best salespeople. Spend a lot of time thinking about that. And how do we make sure that it's running effectively? So in my particular case, at both organizations, you have people who are on the compensation committee who are both business leaders, C-suite executives at their current company or prior companies, as well as venture capital folks. And the perspective on both of them is very, very similar, although those who are from the VC side of things pay a lot more attention to run rate than the one from the more typical corporate environment.
Yeah, I think the onus on GAAP reporting has come up quite a bit, especially with dilution being a top topic and companies offering stock-based compensation. What type of questions do you typically see from a board when a company is in that transitory state, maybe a pre-IPO company looking to IPO or right after IPO where the company is looking for more sustainable practices?
Yeah, my experience is more on the post-IPO side of things, but I will share that they pay a significant amount of attention to that. And knowing the variability in current stock prices depends on the particular organization and the business model, but I found that they really want to have a sensitivity analysis. So if you come to them with a budget at the beginning of the year, they want updates throughout the year, and knowing the volatility of your particular stock and its characteristics, they want to see what is it like at $100 a share, what is it like at $150, $50 a share, because they know that may be something they need to anticipate. And you, as a compensation practitioner, I think what we want to do is be able to understand, hey, if the stock drops down to X, it's a big decrease, what are we going to do? What are our options? What are our alternatives? And in the particular case of when it goes up, like, or do we have an opportunity to be either more generous or more focused and up our approach, increase our grant amounts to certain types of talent, certain types of skill sets, those type of things. And to be able to be proactive and be able to anticipate the questions they're going to have along those lines, because that's what they're going to focus on. Like, not only how do we use it wisely, but how, if we have the opportunities, how do we deploy that excess or that additional funding that we can do and use our equity for.
We talked about proactiveness and reactiveness in compensation a while back. And I think oftentimes the board is on the receiving end of compensation changes. What can we do as practitioners to better prepare our board for what are the changes coming down the line?
Well, first, I think you have to anticipate and prepare your executives for the changes coming down the line. And the way that I think about this is I think that in our compensation field, we tend to operate, and if we talk a 2x2 matrix on sort of criticality of something versus time, we spend a lot of time on the now and urgent issues, urgent things that need to be dealt with now. Oh, we're not competitive in this location, or my goodness, we have to do a retention grant, or we lost this person to OpenAI, or whatever that topic is. And how do we change that conversation for our C-suite executives internally? Because that will lead to that same conversation with the compensation committee and our board. So how do you plant the seeds to say, I see this is the second time we've come and had, we've lost this person to this other company or this type of individual type of skill set to another company. I'd like to come back to you with some data on that and some recommendations on how to address it, and plant the seed that you're going to come back to your C-suite in the next several weeks, months, whatever it might be, and then plant the seeds with them that say, and I want to actually have us raise this with our board and our compensation committee so they can anticipate it. So it's a way of thinking multiple steps ahead to like prompt or seed, I think is the right word that I would use to help us move in that direction.
I love that. For anyone who isn't doing this already, this is going to be one of the biggest takeaways from today, being able to build that executive buy-in from the C-level and above and have that start early, I think is a large part of that. We've talked a little bit about companies needing to be nimble, and as we think about proactivity, and this will come back to the board in a moment here, but I want to give an example specifically around peer groups, where we're finding companies needing to be a little bit more nimble in even how they think about that term. As an example here, there's a company called Gamma. They're a startup in the digital tools and creation space. So they build, PowerPoints and websites. They're now competing with the Canvas, this, cohort of pre-IPO companies that are posturing almost like public companies. I'd put maybe Databricks in this category or a Stripe in this category as well. And then we have the public companies, the Microsofts of the world, the incumbents of PowerPoint. And for a long time, I think we could choose a peer group that was more or less within our relativity. But we're starting to see these upstarts from a talent perspective maybe command some attention. And I'm curious how you think about navigating that conversation around the comp philosophy, but more explicitly the peer group, even all the way up to the board level.
Yeah, I think it's a little less about comp philosophy, but it's also the type of talent that you have to navigate and what they're going to focus on. I think at an executive talent, you want to be able to set your benchmarks, your peg points for those executive roles. And we know that executive pay scales by size. So larger organizations are going to pay more, because you're managing more value, more opportunity. And the boards understand that, but I think they get very reluctant to actually go and say, well, we think we're going to be 10 times as big 2 years from now. And so therefore we picked a peer group, which is held exclusively of companies 10 times our size. That's not going to work. And you're going to get a lot of pressure on that.
Yeah.
There's going to be some thinking that you're probably trying to push the limit and potentially what we call the agent principal concept, that our executives trying to feather their own nest by picking a peer group, which is really, really large. So you have to be aware of that. I do feel like it's reasonable to think of, as a growth company, you're going to be competing and pulling talent and needing to be able to pay at a level at your current size, like 2x, 3x. But you can't do 10x. So I think that is a consideration. Now, below the top tier, when you get into most individual contributor or manager type of jobs, that doesn't scale with size, but it scales with business model, if you would. So Microsoft and Google and Meta, they can afford to pay a lot more because of their business model. They generate more profitability, et cetera, and they have better cash flow. They don't worry about incremental SBC the way that a small company would. And so I think you can have large companies in your broad-based comp philosophy set, but where you target, I think, is another issue. Do you really need to pay 90th percentile to target the same level of talent that another company like a Meta could afford? And in our case at Cloudflare, we don't do that because there's a recognition that we don't compete broadly for talent in that way. But of course, we do it selectively for certain specific skills, and having the flexibility to do that. Now, that gets a little bit away from your peer group concept at the broad-based level, but I would argue you need to have a more narrow, size-based, scope-based group for your executive team, and then you can have a broader, talent-based focus for your broad-based population.
Yeah. We talked about, executive comp a little bit in there. Is there something that you feel is conceptually misunderstood at the board level that distinguishes executive comp from broad-based comp?
Well, I think there is a belief that at the executive level about the impact that they can have on the economics of the business, and not being able to weed out the exogenous factors in the marketplace. There are broad market-based opportunities that and market trends that could affect your performance of your business, the increase in revenue, perhaps. It could be just business model as well. What I have found that there's a skepticism at the board level about the ability to set targets, whether it's an annual target, and particularly for multi-year targets, like for instance doing a performance share type program, and having financial targets that aren't done on like on a relative TSR basis that includes the impact of these exogenous factors on the market. So what I've seen, and there's a publication done by Norges Bank, which is a large sovereign bank of Norway, that they put out a paper that indicated that they don't really trust the metrics that are put into executive comp plans, and they would rather, as investors, just make sure that the executives have a high stake in the company, and that stake is multiple years over time. So their argument is you should just do restricted stock, and it should be sufficient in terms of magnitude relative to their total compensation that keeps you competitive, and it keeps them focused on the long term. And they didn't buy into the idea that you can effectively set metrics for like a PSU program, which is counter to what the proxy advisor firms have done historically.
Yeah.
But I hear a lot of interest in that trends, that we should, rather than try to get into lots of details about the structure of these short and long-term metrics, is rather just give them a sufficient stake that's very large, and that allows them to have a stake in the company and have them manage that.
Yeah. It's interesting that you say that. If you think about what we're seeing today, and maybe, a couple of examples that you just provided around maybe more creatively using the resources we have today, right? Not getting too creative with exec comp. What do you expect exec comp to look like 10 years from now? And do you think it's going to be all that different from broad-based comp?
Well, I still see like the prevalence of incentives. The mix is going to be obviously different. I still believe that 10 years from now, that executive pay is still going to be 90% performance-based pay. Almost all is going to be LTI. The smaller the organization, the more LTI is going to be as a proportion. Fixed comp is going to continue to be smaller, and that is going to be that's going to continue. I do believe that we're going to continue to have greater participation, at least in the tech world, in long-term incentives and stock-based compensation. And most of that stock-based compensation below the executive level, it's probably going to end up being more restricted shares.
Yeah.
Obviously, from a burn rate perspective, options works fine if you're a pre-IPO company, but once you go post-IPO, I think it's a different. The mechanism changes, the focus on the use of shares changes, and therefore, for me, the optimal broad-based population structure is probably a salary and an RSU grant, and potentially bonus if you can then get to a stage where you can predict your metrics very effectively and have a relatively narrow range that you can build around for an annual bonus program.
Yeah.
And on the executive level, I think probably the same, but then just the proportions are going to be different.
Yeah, it's funny you say that. I think we're noticing two of these trends with our customers already today. One of which is the increase of a organization of what we call top talent, a founders list. I mean, it's called something different at every one of our clients, but more of a gravitation towards who are the folks that are driving the business metrics, whether that's increasing revenue or even the bottom line of the product infrastructure, right? So when we think about those two teams, I think we find that companies are expanding essentially that definition of executive comp to sometimes this smaller group of folks that are very meaningful contributors to the company. And so it begs the question of, will exec comp become something where there is more of this in-between state of broad-based comp, the top talent, and then exec comp? And are we creating a new class of compensation as this trend continues to rise? And I guess the other piece I wanted to add there is that I wholeheartedly agree on the RSU piece. We have had clients that are pre-IPO starting to gravitate towards a mix of options and RSUs. I do not think that is a trend that is going to leave in any time in the near future.
Absolutely agree with you on that.
Yeah. Before we move on to compensation committees, very hot topic, I want to talk a little bit about what you would say to any board member, one piece of education or guidance that you think every board needs to have as they think about comp.
Well, I think to have them aware of some of the current trends that we're seeing, and many of the board members, the ones that I deal with, or the ones I've dealt with in the past, they are not into all the specific things about the new trends that are happening in compensation.
It's almost like they have another job or something.
Yeah, that's what they have. That's right. And so there are things like we learn about the predictability and the information you get from offers data. And that's something they don't really know about. It's something we know internally, and we've presented to the head of HR and maybe to our own chief executive officer or CFO as a way to be the harbinger of change. Is this job's value or this skill set's value increasing? The board members don't understand that. They are not familiar with that in general, the ones that I deal with. And so it's good to let them know, the change related to that. And if we see anything related for special skills like AI, ML, is that affecting the work that is being done by core workers? So, for example, are software engineers becoming more productive because they're using AI, and therefore we don't need to hire as many of them in the future? That's the kind of thing that they need to be aware of and thinking about. And if we have from our current surveys, and there's lots of good surveys out there that are giving us new and different information than we've had historically, then I would try to get that kind of thing in front of them.
Yeah.
Again, and doing the planting of the seeds, right, with your own executives, and then getting in front of boards, because they don't get exposed to that in most cases, in my view.
Yeah, it's funny because we're all trying to see into the future a little bit, and I think benchmarking data has been one dimension of that, of how can we see the trends in the data itself. There's also a handful of anecdotal evidence, which I think companies. I don't know if you've been in this exact situation, but we've had board members even come up and say, I heard from so-and-so that they're doing this. Why would a company do that? And so I think there's a fair share of defensive strategy too, of being able to stand by what you're doing, how it's different from other companies that you're maybe competing with, and why it's what's best for the business overall. This is a great segue to compensation committees, because that's a large portion of defending that strategy. But Frank, can you tell us a little bit more about what a compensation committee is, and maybe what are the common pieces of what you share with a compensation committee overall for folks listening?
Well, generally, and with the compensation committee, we have a whole bunch of things that are going to be BAU. So you're going to do, in our case, a quarterly grant list that gets approved, modifications to certain grants to executives, those type of things. What we do look at, and what they are aware of, is that we want to make sure that they understand if there's any risks that are related to our particular compensation program. As probably no surprise, we continue to focus a lot on run rate and changes to our run rate, the impact that we have in our grant. If we're getting into a new business area, a new product area, a new geographic location, how is that going to affect things? Obviously, for example, when you go and you are expanding, instead of expanding in the Bay Area, you expand into other locations, other countries, you may be able to have a lower burn rate, obviously, from going that because the grant levels in these other locations are different, and so it's making sure that they understand the impact of ways that we can do and what levers we can use to actually improve our use of equity and be more efficient than an organization that is solely based in the Bay Area, where you have the highest levels of absolute pay in the world. And they pay a lot of attention to that.
You partner with some of the, industry leaders in technology overall. I mean, Scott Sandell over at NEA and Robin Washington over at Salesforce. What's an example of something that you think the best compensation committees are doing?
Well, I think the best compensation committees are really understanding the characteristics of our talent base and what do we need to be able to hold on. In our particular case, we're a technology company,
right?
But we're also we're also a software company trying to get into the enterprise space, right? And so understanding the places where you really need the best talent. And so if you think about Google, they have been investing so heavily in AI research, obviously,
right,
and in the cloud area. Those are the two areas. And they're investing not only from a technical standpoint, but they're also on the cloud side from sales. And so how do you get really great sales leaders in there to actually drive things? And we're in the same space too, where we care a lot about our technical products and our technical talent at the very senior level and making sure that we have the best people there. But the board members are really focusing on how do you bring in like the best people on the sales side of things, because they know that they want to be able to ensure that over the long term that we generate sufficient revenue. And those of us that are SaaS companies, we pay a lot of attention at our company to the Rule of 40, if you've heard that terminology, which is your revenue growth rate plus your op margin. And believe me, like a Scott Sandell and Carl Ledbetter, who's the other member of our compensation committee, pay a lot of attention and are very aware of the Rule of 40, and are we doing anything that's somehow going to affect it? One of the ways that we have some flexibility there is that because we are doing well from a run rate perspective, we're well under the guidelines and our benchmarks, that gives us flexibility on the equity side that we don't have on the cash side from a non-GAAP basis, right? So that we're very careful about increasing our cash compensation, but we like to invest selectively, and we are investing selectively in how we use our equity compensation.
Yeah. This is a question I probably wouldn't be able to ask most guests, Frank, transparently. What is something that you didn't talk about for the last 2 decades in comp committees that you think is only getting increasingly more popular or a topic of conversation? So much so that, this would be a miss for teams to not prioritize as they think about their communication and stakeholder management to the board, but also comp committee.
I think that I've been a little bit protected in that, I wish that comp committees paid less attention to ISS and Glass Lewis, and they paid a lot of attention for the last 20 years. In my own personal case, since I've been at Google and now at Cloudflare, we have founders who have pretty good stakes in the company, and they have a separate class of voting so that they are able to not worry too much about short-termism. And I think that a lot of comp committees and boards have been a little bit more short-termism oriented. And I really think that what we want to get, and hopefully in the ideal world, is to get to more long-termism about our compensation programs. That's why we think about like, hey, maybe we should just be granting RSUs to our executive team as opposed to some appropriate mix of, some options and some RSUs and PSUs, and we have to keep the proportion at a high enough level that we worry about the shareholder advocacy groups paying attention and perceiving that we're doing things correctly. So, and I understand their role is to make sure that the company is doing the right thing from a governance perspective, but right. I think it's time for them to relook at that per our earlier discussion.
Yeah. I think the dimension or the time frame that teams are looking at this are probably also more or less correlated to the business health and, what are the longevity of the business decisions that are being made. And so I'm sure the two go hand in hand to some degree.
Well, So, for example, yeah, I agree with that. And I won't name names, but there are other organizations that have had some really challenging things. Their market cap has dropped recently. And so the grants that they made last year, which were X% of market cap, are now 2X or whatever it might be.
Yeah.
And that is a really difficult situation to get. You don't have a lot of good options.
Right.
And my belief is you should prioritize for your best people, beyond the executive team, the people that are really going to drive value in your business. And you have to make some super hard choices.
Yeah.
On the other hand, where you have that flexibility in your run rate, that actually gives you more levers to pull, and opportunities to experiment and opportunities to reward people and lock them in for the long term. So I think that there are different circumstances that are going to be more challenging, and I think our compensation committees actually understand that pretty well.
Yeah.
They know when we're in a tight circumstance, and my experience has been that when you're in a tight circumstance and challenging, they are going to be more flexible in what they will allow, knowing that sometimes you have like a super urgent critical thing that needs to be done,
Right.
whether it's a special off-cycle grant for a bunch of people or whatever it might be.
Yeah. My team's going to laugh as they hear this portion of this. We at Complete often say your comp program is only as good as it is understood. And I'm sure you've had a similar experience, but when I've talked to head of total rewards, everyone has had one or two, if not more, experiences of something that they had designed that was beautiful, that was fair, that was equitable, that didn't quite land at comp committee. What's your example, Frank?
That's a good one. I'm trying to. Didn't quite land. It's not the right way to do it, but maybe it was confused, right?
Yeah.
There are some things that we have informed comp committees of that aren't logical. But for example, at Google, you're probably aware that we've did a number of conjoint studies that showed that people devalue grants, the value of grants, and that vest 3, 4, or 5 years out. And so therefore we have had implemented some things like front-loaded vesting for new hire grants. And for many of our comp committee members there and outside, not just at Google, but other places, they don't understand that. It's not logical to them. And so they think about total holding power in terms of total grant, right?
Yeah.
Like, this person has $10 million worth of stock, they're not ever going to go or leave us. But if that person with $10 million only vests in $500,000 this year and $100,000 this year, and then it's backloaded in $8 million in year 4, that is less of a holding power than they perceive. And it's good for us to be able to explain that there have been statistical studies and there's successful stories at other companies that demonstrate that this is actually a really good idea. And that I would make the point of using examples and iconic examples, right? You can talk about it's public record about what certain companies do, what Google does, and how they target. There are certain other companies that have backloaded vesting or managed to cash flows that I don't actually like. But you can talk about that, and I can remember that my colleagues at other companies had told me, we can't compete against you when I was at Google because that you're front-loading all this information, all this pay. And how do you do that? How did you get approval? Because we know that we're backloaded, and therefore we go head-to-head, we just give up.
Yeah.
Right? So there's ways to use those kinds of stories, those kind of examples, to demonstrate that this is a way that has been proven very effectively. And you don't even have to name names. I think you can use, you can say, at my peer group that I went to, or the conference I went to, here are some examples of 3 large tech companies, and here's what they did. And this is how, and they demonstrated or presented that it was very effective. And I think we should consider that here. So you don't actually have to quote that Frank Wagner said this or Ronnie said that. It really is an opportunity to tell a narrative, a narrative that's based on real experiences from other organizations, and to bring that into your comp committee to help sell.
I couldn't agree more. And, as we wrap up here, there are 2 last questions I want to ask. But, I think one thing that you really hit home there for me, Frank, is that there is a lot of onus on organizations to be not just looking at what they're doing internally, but looking at the periphery. And, if your teams aren't doing this already, spend even 30 minutes a week, a month to understand NVIDIA is the newest entrant to the front-loaded grant club. So I'm excited to chat more with them about, their thought process around getting there as well. But having that proxy for what's happening elsewhere is really important. As you think about the future of compensation, what do you think is something that's been accepted in comp that will be challenged?
And this goes outside of the tech world. I think that, for lack of a better word, in the broad-based field, there's this thought that there's a job evaluation methodology where we measure skills and score jobs where you have lack of market data. And I think the real-time market data that's available, as well as the historic market data and judgments you can make about job architecture, means that the market value, as opposed to a determined value or subjective value, is going to be preeminent. It's market value going to be preeminent in compensation, and the idea that non-tech organizations use, like these evaluation systems.
Sure.
I think they'll go by the wayside.
Yeah. Well, before we wrap up here, Frank, one last question for you. We like to ask everyone that we have here join us with Complete, what is one piece of guidance that you would like to give a current head of total rewards, a future head of total rewards, maybe someone embarking on their first journey with a comp committee or a board? What is your advice for them?
Well, I think that for anyone in the compensation field, it's good to stay on top of trends, and that's sort of a baseline. So I would start with that. So make sure you're getting information, go to conferences, tune into webinars, read the latest trends, read your anything that you issue on findings and so forth. So I think that's sort of a baseline thing that I would think about. But the other, I would say there's two other things that I would do. One is to understand the actual business that you have and how it operates. Because if you're a conversion in that, you have a lot more credibility with your executive team internally, and will have more credibility with your compensation committee too. And the other thing that I would say is to get a baseline level of financial acumen. So we toss about the things like run rates and GAAP accounting and non-GAAP, SBC, stock-based compensation. It's good to understand all those terms and what is important to your organization.
Right.
You have folks that probably consult with you and your board, these external firms. Tap into them, ask them questions. If you have a meeting with your finance team, tap into them and ask them questions, have them explain things. People love to be able to share their knowledge and experience. And I think that having this intellectual curiosity along your business and just finances, financial knowledge in general, is a really good thing for any up-and-coming compensation professional to have.
Regardless of which executive you are, the head of compensation, head of total rewards, head of HR, you are a business leader at the end of the day. You have to understand the P&L. Couldn't agree more.
Absolutely right.
Thank you so much, Frank. It is such an honor to have you today.
Oh, my pleasure. Thank you.
Thank you. All right. Yeah.
All right. Woo.
How do you feel?
Oh, that was good. I'm sure there's principles that we follow from a cultural standpoint about how we operate the business, and one of which is transparency about like our product and when things mess up and so forth.
Right.
I find that our leaders are not so interested in being quite as transparent when things don't work well in compensation or in benefits as well. And so I'm not sure how you bring the culture in, except most importantly would be the behavioral aspects of the kind of things that you expect employees to do.
Right.
It's another way of saying we don't tolerate like geniuses who are jerks. So that was sort of a Google kind of thing that we talked about. But we're that way.
Googliness.
Yeah, googliness. Yeah. You had to be googly. And like for example, at Cloudflare, we have 6 principles that we follow about like show empathy when you're speaking with people, and GSD, get stuff done, and be transparent about and so forth. And so I think the way you bring culture into your comp programs is how you reward them, like the basis upon how you reward them. And it's about you have to deliver on the what,
Right.
what you accomplish, but how you do it is important. And I think if companies have that value, they should incorporate that into how they measure people and therefore how they reward people. So that's how I think about it.
Couldn't agree more. I think there are two dimensions too, right? There's what we measure and how often we measure it.
Yeah.
I think we've already increased the number of instruments of measurement, and the next dimension is going to be how often we measure it. If markets are changing more or less real time, does that mean we're doing more quarterly reviews of market data? Does that mean that we're, doing more ad hoc grants? And I don't think that's a trend that's going to go away anytime soon. I think there are already companies that are toying with the monthly refreshers or tightening up the windows. And
well, I think in that case, I would probably say that's because they are so volatile that they have to do something to offset the volatility and deliver like a consistent value over time. So you it's sort of like a portfolio effect, right? You're getting the effect of, at this price, and so forth as it moves forward. I do want to trend up, because if you do that, you have to do it algorithmically, because you don't want managers distracted from the business and doing like a pay action every quarter.
Yes.
Or every month for it has to be done like systematically. You can't
Completely.
like
the room for bias there would very much worry me.
Also true. Yeah.
Thank you so much, Frank.
All right, thanks.